Hello, my name is Mike from Great Oceania. In this video, I'm going to show you how to read the bank statement correctly. Now, before we understand how to read the bank statement, we got to know how the bank calculates your interest. It's what we call calculate daily and compound monthly. So the bank calculates your interest every day and adds the interest into your loan monthly. How the bank calculate your interest? The bank use this formula, your loan balance minus your offset account money, assuming it's a variable loan, multiple by the interest rate and divided by 365 days. Let us give an example. Hypothetically, if you owe the bank 500,000 and you went to the Crown Casino and you won 500,000 in your saving account. So 500,000 minus 500,000 equals to 0. Multiply by whatever interest rate and divide it by the 365 days. So congratulations, your 1 day interest is 0. Now every month, the bank will adds up all your interest together, 28 days, 30 days, or 31 days, and then adds up this money into your loan principal. Then you may ask, okay, in that way, I can never pay back the loan because the bank actually roll over the interest into my principal. Hang on, the bank actually have the agreed direct debit with you when you set up your loan. Okay, if you were on principal and interest repayment, monthly, hypothetically, the bank will charge you a agreed amount to pay back the loan. If you were on a interest only, the bank will charge you interest only to pay back the loan. Now, let us look at this particular bank statement. This particular customers owe the bank 363,000 approximate. You can see the loan balance has been reduced gradually. Now, this customer also have the offset account in the saving, 362,000. So hypothetically, assuming what we have been discussing, now this customer should be charged quite minimal interest. Now look at the left-hand side is the date, the detail, the category, debit, credit, and the loan balance. For example, in January, this customer has been only charged interest by approximate $82 because the bank used the loan balance, 365,000 minus the offset account money, 362,000 equals to minimal interest. So the bank only charged $82 for the interest for that month. But on the same month, now the customer actually charged the credit, which is the principal and interest repayment, 2,300. So the difference between that $2,382 will be the deduction back to the principal of the balance. Now, the same philosophy, the customer has been charged minimal interest in February, but the same agreed amount principal and interest, 2,300. So the difference goes into the customer's balance, which is the principal of the loan. Now, we got some conclusion here. The more money in your offset account, the better. So you should save more money in your offset. The sooner you have money in your offset account, the better. So hypothetically, if you go to the same Crown Casino and very fortunately you won the same amount, you put into your offset account, and from that day, you no longer have been charged any interest, and the bank is not making any profit on you. What you are paying monthly is only the original principal that you borrow from the bank. Now, the more frequent that you pay back your loan, the better. So if you have weekly or monthly or fortnightly repayment, that will be better than monthly repayment. And the last point is always randomly check your bank statement and calculate and make sure the bank has been charging you the interest correctly.